In every era, there is a moment when wealth doesn't just decline, it evaporates. Not slowly, not predictably, but violently, mechanically, with a precision that turns decades of prosperity into months of destruction. And here's the part nobody wants to believe. That moment is beginning again, right now, in 2025, because the pattern that destroyed fortunes in 1929, that erased an entire generation of wealth in Japan in 1989, that shattered the global financial system in 2008, has reactivated. The same signals, the same psychology, the same mathematical structure beneath the surface, different technology, different headlines, but the identical engine. Every major wealth destruction event in the last 120 years has begun the same way. A period of artificial prosperity fueled by cheap capital, an illusion of safety created by rising asset prices, a belief repeated every generation that this time is different. And then, without warning, the sequence flips. Leverage unwinds. Liquidity evaporates. Investors who spent years getting rich suddenly learn the same brutal lesson. Wealth built on excess always disappears faster than it was created. Right now. In 2025, all four pre-collapse indicators are flashing together for the first time since 2007. Insider selling is at a 17-year high. Margin debt has surged back to near record levels. Valuations have separated from earnings at a scale not seen since the dot-com bubble. And the most sophisticated investors in the world, Buffett, Bezos, private family offices, are quietly exiting while retail investors keep buying. This isn't fear-mongering. This isn't speculation. This is pattern recognition, because history doesn't repeat through coincidence. It repeats because the incentives never change. When capital becomes cheap, humans behave the same. When markets become euphoric, risk becomes invisible. When the system becomes over-leveraged, it doesn't matter how advanced the economy looks, the mathematics always wins. And once this pattern begins, once the pressure builds beneath the surface, nothing, not the Federal Reserve, not government policy, not technology, not optimism, can stop what comes next. The only question that matters is whether people see the pattern before the collapse, or after their wealth has already been erased, because we are no longer entering the cycle. We are already deep inside it, and 2025 is shaping up exactly like the final stage, the stage that comes right before the break. To understand why, to see the mechanism forming under our feet, we need to rewind the clock, back to the moment when this cycle first revealed itself, long before anyone alive today knew what was coming, a moment in history whose mathematics is now repeating, almost line for line, and that's where the real story begins. To understand the wealth destruction pattern forming in 2025, we need to return to a moment when the world still believed prosperity was permanent, a moment when the foundation of the modern financial system was being quietly rewired. The year is 1920. The First World War has ended. America has emerged transformed, no longer a debtor nation, but the world's new creditor. Factories built for wartime production stand silent, waiting to be repurposed. Banks are flush with cash. And for the first time in its young history, the United States possesses the one thing every rising empire needs: monetary power. But beneath this newfound strength lies an invisible shift, a shift that will ignite the greatest market collapse the world had ever seen. The Federal Reserve, created only 7 years earlier, is still an experimental institution. Its leaders believe they can control the economy by managing the cost of money. So when a brief post-war recession hits in 1920-21, the Fed makes a decision that will define the decade. They open the floodgates. Interest rates fall. Credit becomes cheap. Banks begin lending with an optimism the country has never witnessed. For the first time, consumption is no longer tied to savings. You don't wait to afford something. You borrow. Cars, radios, refrigerators, homes, stocks. The psychology of an entire nation shifts from discipline to desire. But here's what nobody understood at the time. Cheap credit doesn't just stimulate the economy, it rewires human nature. Why work longer for slow returns when speculation offers fast ones? Why invest in productivity when leverage doubles your money in months? Why save when borrowing feels like progress? By 1924, the engine is running at full speed. Stock prices are rising. Corporate debt is expanding. New financial products are emerging faster than anyone can evaluate them. And yet, it doesn't feel like danger. It feels like evolution. It feels like America has finally discovered the formula for endless prosperity. Newspapers celebrate the permanently high plateau. Banks loosen standards. Brokerage houses expand. Politicians promise a future without past cycles. But in the shadows, the mechanism of collapse is already forming. Not through fraud, not through malice, but through mathematics. Every dollar borrowed to buy assets pushes those assets higher. Every increase in price convinces more people that prices can't fall. Every borrower relies on future price increases to justify today's debt. And that cycle, once started, moves in only one direction. The bubble becomes self-reinforcing. Optimism hardens into ideology. Markets stop reflecting value and begin reflecting belief. By 1927, the gap between financial reality and economic reality is widening. Asset prices are climbing exponentially while earnings rise slowly. Speculation becomes the national sport. Ordinary families are opening brokerage accounts. Factories produce not just goods, but confidence. And the Federal Reserve, trying to support a fragile Europe recovering from war, cuts rates again, unaware they are pouring fuel on a structure that cannot withstand its own weight. It is here, in this moment, that the modern wealth destruction pattern takes its final shape. Cheap money, leverage, asset inflation, mass participation, systemic fragility, a pattern so universal that it will reappear with eerie precision. In Japan in 1989, in the dot-com boom of 2000, in the housing bubble of 2008, and again, unmistakably, in 2025. The danger of these periods isn't sudden collapse, it's the years of quiet buildup that make collapse inevitable. Because once a society shifts from wealth creation to wealth extraction, from investing in productivity to speculating on price, the outcome ceases to be a question of if and becomes a question of when. And that brings us to the next chapter. The historical cases that prove this pattern is not a theory, but a cycle. One that empires, markets, and institutions repeat again and again, no matter how advanced they believe they've become. To see 2025 clearly, we must revisit the collapses that came before. History does not repeat in detail, but when money becomes cheap, when confidence becomes religion, the sequence is always the same. And to understand what is forming beneath the surface in 2025, we must revisit the three great collapses of the last century. Three different nations, three different cultures, yet all destroyed by the same underlying engine: leverage, mispricing, and the illusion of permanence. The first collapse begins in the United States at the end of the 1920s. America believed it had transcended cycles. Newspapers celebrated a new era. The Federal Reserve insisted stability had been mastered. Ordinary families, empowered by cheap credit, believed wealth was simply the natural state of a modern nation. But beneath the prosperity, a silent multiplication machine was expanding. Margin debt, loans used to buy stocks, exploded 800% from 1921 to 1929. Speculators could buy stocks with 10% down. 10% correction wiped them out. A 20% drop destroyed the system. It was the perfect formula for catastrophe. Every dollar in stocks was supported by 9 borrowed dollars. When prices fell, the collateral evaporated instantly. Then came the inevitable cascade: margin calls, forced liquidations, broker failures, bank failures, and credit contraction. 89% of market wealth vanished, not gradually, but mechanically, as the same leverage that created the boom became the engine of destruction. The system had grown so overextended that even a small decline ignited a chain reaction across the Pacific. Decades later, Japan repeated the same mistake with even greater magnitude. By the late 1980s, Japan was the richest nation on Earth. Its stock market soared. Its real estate became the most expensive in human history. A few blocks of Tokyo were valued higher than all of California. But beneath the euphoria, Japan had quietly assembled the same structure America had built in the 1920s, a mountain of leverage resting on inflated collateral. Banks lent against rising land prices. Corporations borrowed to buy more land. Households borrowed to buy stocks. The central bank kept rates low to support growth. It was a self-feeding loop, rising prices fueling more borrowing. More borrowing fueling more rising prices. Then in 1989, a slight tightening of interest rates made the entire structure buckle. The bubble didn't deflate, it imploded. Stocks collapsed 82%. Real estate values fell for 3 decades. An entire generation of Japanese wealth evaporated, and the country entered a deflationary twilight. It still has not fully escaped. Once again, the destructive force wasn't panic or speculation. It was the simple fact that when leverage is built on inflated prices, Every correction becomes catastrophic. 2 decades later, the world watched the same pattern unfold again, this time in American suburbs. The 2000s saw the democratization of credit, mortgages for everyone, no documentation needed. Banks engineered complex derivatives on top of these mortgages. Investors bought them, believing the risk was diversified. Homeowners borrowed against rising home values, convinced that prices could not fall nationwide. It was the logic of 1929 and the psychology of 1989, repackaged into the illusion of modern financial engineering. By 2007, major institutions were leveraged 30-to-1. A 3% decline in housing prices, something previously considered impossible, was enough to wipe them out. And when the decline came, the system turned in on itself. Credit derivatives collapsed, markets froze, trillions evaporated. Within months, the world experienced the largest coordinated wealth destruction since the Great Depression. 3 different eras, 3 different markets, 3 different empires, and yet a single, identical pattern. Cheap money leads to rising asset prices. Rising prices lead to borrowing. Borrowing pushes prices higher. Then the smallest downturn forces selling. Selling triggers collapse. Collapse destroys wealth. A 7-stage chain reaction that has repeated with mathematical precision for more than a century. And now, in 2025, every part of this sequence is returning. The surge in margin debt, the speculative valuations, the record levels of insider selling, the concentration of risk in AI-driven megacaps, the rapid expansion of derivatives, and central banks trapped between inflation and recession. The architecture is familiar. The pressure is identical. The cycle is already in motion. To understand how close we are to the breaking point, we must stop looking backward and look directly at what is unfolding in the U.S. financial system today. Because the same mechanism that destroyed wealth in 1929, 1989, and 2008 is no longer historical theory. It is present tense. If history were merely echoing in the background, the situation would be concerning. But in 2025, the historical pattern isn't echoing. It's reconstructing itself, piece by piece, inside the U.S. financial system. Every indicator that preceded past wealth destruction cycles is not only present today, but amplified by a modern economy more leveraged, more interconnected, and more fragile than any the world has seen. Start with valuations, the foundation of every bubble. For the first time since the dot-com boom, the gap between stock prices and earnings has reached levels that even the most optimistic models struggle to justify. Megacap AI stocks trade at multiples that imply perpetual, exponential growth. Companies lose money but see their valuations surge simply by adding AI to a press release. Analysts justify it by pointing to innovation, the same way analysts in 1999 justified internet stocks with phrases like new paradigm and unlimited potential. But markets never collapse because valuations are high. They collapse because valuations detach from cash flow while leverage multiplies the risk. And that's exactly what's happening. Margin debt, in the silent accelerant behind every boom, has surged back toward record highs. Investors, convinced the AI rally is unstoppable, are borrowing heavily to chase returns. Hedge funds are using leverage to amplify bets on a handful of tech giants. Retail investors, encouraged by social media and zero-commission trading, are repeating the logic of the late 1920s. If it keeps going up, why not borrow to buy more? At the same time, corporate executives, the people closest to the internal numbers, are unloading shares at a scale not seen since 2007. Insider selling has reached a 17-year high when CEOs, CFOs, and board members sell billions in stock while publicly praising the long-term outlook. It is not speculation, it is information. Executives don't liquidate into strength unless they expect turbulence ahead. Warren Buffett, the most disciplined capital allocator in modern history, is sitting on the largest cash pile Berkshire Hathaway has ever held. Not because he wants safety, but because he can't find anything priced attractively. He is doing what Joseph Kennedy did in 1929 and what Michael Burry did in 2005, exiting the consensus trade before the math flips. But these aren't even the most dangerous cracks. The real fragility lies in the plumbing of the financial system, the places ordinary investors never look. Commercial real estate valuations are collapsing in major cities. Office buildings sit half empty while loans tied to those buildings approach refinancing cliffs at higher interest rates. Regional banks, which hold the majority of these loans, are already showing signs of stress. A few failures have been contained, But the system resembles 2007. Problems that look manageable until they suddenly aren't. Derivatives tied to AI-driven tech stocks are ballooning. Options volume has exploded, with short-dated contracts driving price swings rather than fundamentals. This creates a reflexive loop. Options dictate stock movements dictate more options, and leverage hides inside the structures. Meanwhile, household debt has reached an all-time high. Americans are borrowing at record rates to maintain lifestyles that wages no longer support. Credit card balances have surpassed $1.3 trillion. Our delinquencies are accelerating across auto loans, personal loans, and buy now, pay later programs. It is the same pattern that formed before 2008, not in housing this time, but in consumer credit. And above it all sits the Federal Reserve, trapped in a contradiction with no historical parallel. Inflation remains sticky. The cost of living continues rising faster than wages. The Fed knows lowering rates too quickly will reignite inflation, but keeping rates high accelerates the debt tightening that cracks the system. This is the trap that no modern central bank has escaped. Inflation on one side, financial fragility on the other. In 1929, this trap was created by margin debt and speculative excess. In 1989, Japan, it was land prices and corporate leverage. In 2008, it was housing, derivatives, and shadow banking. In 2025, it is all three at once, amplified by technology, accelerated by liquidity, and multiplied through global interconnectedness. The dangerous part is not that the system is stressed. It's that the system has become so dependent on rising asset prices that even a small correction can trigger forced liquidation across multiple sectors. As AI stocks climb, they become a larger share of index funds. As index funds concentrate, passive investing pushes more money into the same few names. As volatility declines, leverage increases. As leverage increases, the tolerance for losses decreases. And when tolerance collapses even briefly, the entire structure can flip. It is the same mechanical chain reaction that destroyed wealth in 1929, 1989, and 2008. But today, the accelerant is stronger, the participants are larger, and the system is more tightly wound. This is not a forecast. This is not alarmism. This is the architecture of the present moment and the mathematics beneath it. To understand why the next phase will be far more violent than the cycles that came before, we need to examine the factor no past generation had to confront: acceleration. Because in 2025, the pattern is not just repeating, it is speeding up. If past cycles collapsed under the weight of leverage and mispricing, then 2025 stands on the edge of something even more dangerous, a system where every force that once triggered a slow unwind now triggers an instantaneous collapse. Because unlike 1929, unlike Japan in 1989, unlike the housing bubble in 2008, today's financial architecture is wired for speed. Information moves instantly. Capital moves instantly. Panic moves instantly. And leverage, the true accelerant of every crisis, replicates itself across algorithms, funds, and portfolios with a velocity no past era ever had to confront. The first acceleration mechanism is technology. Financial markets are no longer driven primarily by humans but by machines. Algorithms, high-frequency traders, quant strategies, all of them operating without emotion, without hesitation, reacting to micro-changes in price within milliseconds. In past cycles, fear took days or weeks to spread. Today, panic can ignite in seconds. A single trigger, an earnings miss, a policy comment, a geopolitical shock can ripple through automated systems at the speed of light, causing billions to move before retail investors even see the headline. The second acceleration is passive investing. In 1990, passive funds were a footnote in market structure. In 2000, they were an alternative. Today, they own more than half of the U.S. stock market. Passive funds don't choose what to buy. They buy whatever the index tells them to. And when investors withdraw from these funds, they don't choose what to sell. They sell everything, all at once, in proportion to its weight. This creates a circular dependency. As a small handful of mega-cap stocks rise, they become a larger portion of the index. As they become larger, passive funds allocate even more capital to them. This forces their prices higher, which then forces more passive inflows. It is the most powerful feedback loop in modern market history, one that works beautifully on the way up and catastrophically on the way down. The third acceleration is derivatives. In 2008, the derivatives market nearly destroyed the global economy. But even then, most derivatives were tied to mortgages and credit instruments. Today, the explosion is in equity options, specifically short-dated contracts that expire in days or even hours. This has turned markets into reflexive machines. Options move stocks, stocks move options, and leverage hides inside every contract. When prices fall, market makers must hedge by selling even more shares, pushing prices lower, triggering more hedging, more selling, more forced liquidation. It is the same doom loop that accelerated the crash in 1987, but now it operates daily, and at a far larger scale. The fourth acceleration is debt, not just its size, but its structure. In 1929, margin debt was a narrow problem. In 2008, mortgage debt broke the system. In 2025, every part of the U.S. economy is leveraged at the same time. Government debt has surpassed levels that were previously associated only with wartime emergencies. Corporate debt sits near all-time highs, especially in sectors with slowing revenue growth. Household debt has reached records across credit cards, autos, and personal loans. State and local governments face funding gaps that depend on rising asset prices to fill. This means the entire system is now synchronized. If one sector cracks, the pressure transmits instantly to every other sector. There is no buffer. There is no isolation. The margin for error has disappeared. The fifth acceleration is geopolitical fragmentation. For the first time in decades, the global economy is no longer aligned around a single monetary system. The US, China, Europe, and the Middle East are all competing for technological, financial, and energy dominance. This competition increases volatility, disrupts supply chains, and injects uncertainty into markets already stretched thin. When the world fractures, capital seeks safety. But when every region carries its own form of fragility, there is no obvious safe haven. Risk has become globalized, but stability has not. All of this creates a final acceleration force, one that did not exist in any previous collapse: the speed of collective belief. In 1929, sentiment was local and slow. In 1989, Japan, sentiment was national and controlled. In 2008, sentiment was global, but still filtered through traditional media. In 2025, belief spreads through millions of interconnected digital channels, algorithmically amplified, emotionally charged, and synchronized in real time. A rumor can become a panic can become a crash can become a systemic event, all before policymakers even issue a statement. The system is no longer merely vulnerable, it is primed. Not because a single shock will destroy it, but because the architecture ensures that once the turn begins, the acceleration will be instantaneous. This is why the next collapse, whenever it ignites, will unfold faster than the human mind expects. It will not look like a slow-motion recession. It will look like a trap snapping shut. A century of financial innovation has compressed the distance between stability and crisis until the two sit side by side, separated only by a few basis points, a few algorithmic signals, a few margin calls, and now, with valuation stretched, leverage elevated, and confidence fragile, the cycle stands exactly where past collapses stood, the final stage, which leads to the last question, the only one history leaves unanswered. What happens when a pattern this powerful, this universal, and this mathematically precise collides with a system more fragile and faster moving than any in recorded history? To answer that, we must step into the final chapter, the inevitable outcome. There always comes a moment, quiet, ordinary, unnoticed, when a system built on confidence begins to tremble, not because of a headline, not because of a crisis, but because the underlying structure no longer supports the weight placed upon it. That moment is never recognized in real time, not in 1929, not in 1989, not in 2008, and it will not be recognized in 2025, because collapses do not begin with chaos. They begin with doubt, the smallest fracture in collective belief. A company misses earnings. A major bank reveals liquidity issues. A geopolitical shock rattles markets. A central bank statement is interpreted the wrong way. Something small, something containable, something people tell themselves is temporary. But in an over-leveraged system, nothing is small, nothing is containable, nothing is temporary. A tiny drop in asset prices forces selling. Selling becomes forced liquidation. Forced liquidation becomes a liquidity freeze. Liquidity freeze becomes panic. This is the mathematics of every collapse. Simple, brutal, indifferent. And once the first domino falls, once confidence breaks even slightly, the system transitions into its final state, unwind. Prices do not fall, they gap. Liquidity does not thin, it vanishes. Investors do not rotate, they run. The same algorithms that pushed markets up begin pushing them down. Passive funds, which accumulated capital without question, begin unloading without discretion. Derivatives that amplified gains now amplify losses. Margin debt, invisible on the way up, becomes a weapon pressed against the throat of every investor who borrowed to keep up with the boom. It is here, in this violent repricing, that wealth destruction becomes unavoidable. Portfolios built over decades are wiped out in weeks. Retirement accounts shrink. Corporate balance sheets implode. Entire sectors decouple from their valuations. Banks tighten lending. Households cut spending. Consumers panic. Firms lay off workers. Earnings fall. And the system, once again, proves something no modern society ever wants to accept. Wealth is not simply created. It is rented from stability. And when stability disappears, the rent comes due. But the deeper truth, the one history reveals every time, is that collapses are not the end of cycles. They are the clearing mechanism, the reset, the recalibration. The collapse strips out excess. It exposes the leverage nobody wanted to see. It forces a return to fundamentals. It destroys the illusions that fueled the boom. It resets valuations to levels grounded in reality rather than hope. And after the destruction, after the forced humility, a new cycle begins slowly, painfully, honestly. This is the rhythm of markets, not because humans want it, but because mathematics requires it. No empire has avoided it. No financial system has outgrown it. No generation has been exempt. And in 2025, the United States, like every great power before it, stands inside the same pattern, at the same stage, facing the same outcome. The signals are here, the structure is visible, the sequence is unfolding, the acceleration is unmistakable. Whether the break comes from a hidden weakness in the banking system, from a liquidity shock in the AI complex, from a geopolitical rupture, from a policy error, the trigger is less important than the architecture, because once the system reaches this level of fragility, the cause does not matter. The outcome does. This is the part people resist, the part they deny, the part they only understand in hindsight. But every cycle, every empire, every generation eventually arrives at the same realization. History doesn't repeat, it accelerates. And the pattern unfolding in 2025 is not new. It is the same wealth destruction cycle that ended the Roaring '20s, that crushed Japan's miracle economy, that shattered the global illusion of 2008, now returning in a faster, more interconnected, more leveraged world. You can ignore the signals. You can dismiss the pattern. You can insist the system is too advanced, too sophisticated, too engineered to fail. But the mathematics does not care, and that is why the outcome is inevitable. The cycle has begun. The pressure is building, and the break, whenever it arrives, will follow the same sequence it has followed for a century. Not because the world is doomed, but because the system we built still runs on the same silent laws that governed every collapse before this one. This is the pattern, and we are already inside it.